Hello, good evening, everyone. My host, please confirm you can hear me.
Yeah, loud and clear. I can hear you, Prof.
Thank you. All right. I want to welcome you guys to our class. I I want to believe you have a very nice day. Okay. I'm going to use the next 5 minutes to recap on what we did the last time. Okay, so that we can allow some of our students to also join us. So the last time we met, we did a recap, or we were able to conclude IFRS 5, assets held for sale and discontinued operations. Then we move ahead to look at IS 10, okay? That's events after the reporting period. I remember we said events after the reporting period are those events both favorable and unfavorable that occur between the end of the balance sheet date but before financial statements are authorized for issue. And we also said there are two types of events. Okay, number one, adjusting events, and number two is non-adjusting events. So if you remember, we said an adjusting event are those events that provides further evidence of condition that existed at the balance sheet date. Okay. We gave some examples. We said, for example, sale of inventory below their net realizable value. Okay. Discovery of fraud or error after the reporting period. Okay. The receipt of bankruptcy of a customer after the reporting period. So those are those examples that are indicative of condition that existed at the balance sheet date. And we said an adjusting event will result into, you know, changing the figures recognized in the financial statement. Then we are to look at non-adjusting events. We said a non-adjusting event are those events that arose, okay, they're indicative of conditions that arose after the balance sheet date. For example, major business combination, restructuring, dividend, equity dividend paid. Okay. I think I emphasize so much on equity dividend, all right? Disposal or purchases of major assets. Okay, so those are the examples of a non-adjusting event. And as per IS 10, a non-adjusting event only require a disclosure in the financial statement. So that means we're going to disclose the nature of the event and the estimate of the financial effect of the event. However, if a non-adjusting event will impact ongoing concern of an entity, then to be treated as an adjusting event. Then we're able also to look at the problems with IS10, that's window dressing. Okay, that's window dressing. And we said that window dressing is an attempt to artificially improve the performance of a company. Okay, and what is adjusting or non-adjusting? Sometimes in practice, it's quite difficult to determine whether an event is actually an adjusting event or a non-adjusting event. So that's also part of problems of IS10. However, if IS10 is applied properly, okay, supposed to keep window dressing at bay. All right. Uh, that was where we stopped last time. Okay, so today we shall be looking at two standards if time will permit us. If we have enough time, we'll go to the third standard, but let's see whether we can cover two standards in the next couple of minutes. IS 41, agriculture, okay? As I said earlier, this is a standard that most students, they don't even know it exists at all, right? And even people that knows it exists, they don't really pay attention to it. And these are the trick that the examiner, give to students. They capitalize on this, and it's a standard that is quite simple. So in case you meet it in your exams, it will take you 10 to 15 minutes to solve whatever question we set on agriculture. So that's why looking at it earlier so that we don't forget it is very important because it forms part of your syllabus. Okay, so in the next 20 to 30 minutes, you should be able to deal with IS 41. So I want to believe we are ready for today's class. Okay, I think I have more participants now, so we can start. Okay, so we are looking at IS 41, agriculture. Now, I'm not a farmer, really, okay? So I may not be able to, go deeper in terms of agricultural terms, but I know the accounting part, okay, of agriculture. So I may not know all those seeds, all those crops. I forgot what we did. It was in secondary school or primary school then, Greek, right? But we are looking at the accounting aspect, so I can, relate with the accounting aspect. So I want you to, listen carefully, and let's do this together. Now, IS 41 applies to two things, just two things. Number one, biological assets and agricultural produce. Okay, IS 41 applies to biological assets and agricultural produce. Okay, now, what is a biological asset? Obviously, everybody will ask you, but we need to know. A biological asset is a living plant or animal. Okay, biological asset is a living plant or animal. Like I said, I'm not really sure the examiner will bother you about the definition, but we need to know because it's going to assist us when we get to counting treatment. So, a part of technical definition that you might need to be aware of is that a biological asset is a living plant or animal. So if you have a plant, I'm sure you know what plant is, right? Plantation, maybe palm tree. Like I said, I'm not a farmer, so but I'll just try, right? Maybe palm tree, what other thing? Cassava, maize. Okay, so those are living plants or animal. Okay, I'm sure you know animal now. I mean lion, goat, all those things. Okay, so those are biological assets. Now, what is agricultural produce? Okay, agricultural produce is the harvested product of the entity's biological asset. All right, agricultural produce is the harvested product of the entity's biological asset. So, what does that mean? So, if I have a cassava plantation or I have a maize plantation, okay, cassava plantation itself is a living plant, okay. Now, so if I harvest my cassava or I harvest my maize, all right, so that is what I mean by agricultural produce. Can you see? So that means IS 41 applies to the biological asset itself, which could be a living plant or animal, okay, and the produce, that's agricultural produce. So we're going to deal with this, okay. Now, what is harvest? Like I said, you don't need to bother yourself about those definitions, but you need to understand it because it's going to assist us when solving simple questions. Okay, they are so simple. Okay, harvest is the detachment, okay, of the produce from biological assets or cessation of the biological assets processes. Okay, so that's your harvest. Like I said, so if you remove maize, corn, cassava, granite, rice, and the likes. Okay, so that's what I mean by the harvest. Okay, so let's now look at application of the definition. Now, let's see. A farmer buys a dairy calf. Okay, the calf is a biological asset. Okay, so if you go to the market, like a farmer, for example, bought a dairy calf, the calf is a biological asset. Now, the calf grows into a mature cow. Okay, growth is what we call biological transformation. Okay, biological transformation. We are not doing biology here or Greek here, right? But you just needed to, understand that. I cannot even teach you biology. So I don't know. I don't know it at all. Okay, now the farmer milks the cow. Yeah, this one makes sense, right? Now the milk has been harvested. Okay, so milk is an agricultural produce. That's it. That's just the process. Okay, so you buy a calf. The calf is a biological asset. You grow the calf to mature into a cow. That's what we call biological transformation. All right. So when the cow is now mature, you're now milking the cow. So that milk is an harvest. Okay, you have harvested the milk, which is also the agricultural produce. So you can also go to the market and buy, is it hen now, or what they call it, the cockerel here, layers. Okay, so when the layer grows up, that's biological transformation, and the layer or the cockerel now start to lay eggs. All right, so those eggs are harvested, so they are agricultural produce. That's it. It's as simple as that. Okay, now let's look at this biological asset. Don't forget, anytime you remember IS 41, it deals with two things: biological asset and agricultural produce. And that's all. That's everything we are looking at. That's it. Okay. Now let's look at biological asset. Don't forget, I told you that when you look at standards, you look at four things. You remember: technical definition, recognition criteria, measurement criteria, and disclosure requirements. So we have successfully looked at the technical definition. So let's look at recognition criteria. Now, before you can recognize a biological asset in your books of account, three conditions must be met. Number one, it must be probable that future economic benefit will flow to the entity from the asset. Number two, the cost or fair value of the asset can be measured reliably. And the last one, the entity controls the asset. Okay, so those are the three conditions that must be met before you can recognize a biological asset. That's it. That's it. We are done with recognition criteria as far as uh, biological asset is concerned. Now, let's now look at measurement criteria. I know, as I've been explaining, measurement has to do with the value. Okay, so my biological asset has met the criteria, so I can go ahead and recognize it on my financial statement. So how much value? Now, anytime you look at recognition or initial recognition or measurement, okay, you have what we call, anytime you look at measurement, really, you have what we call initial recognition. So when you hear the word initial measurement or recognition, it simply means that the first time you are bringing the asset for the first time into your financial statement, okay? You are bringing the asset for the first time into your financial statement, okay? Now, on initial recognition, now listen, unlike every other standard or any other standard, that their initial recognition is at cost. Now, this is different. Now, biological assets are initially measured at fair value, less cost to sell. That's it. Okay. Biological assets are initially measured at fair value, less cost to sell. I'm sure everybody knows what is fair value now. That's why I did impairment first, then went ahead to look at IFRS 5, all right? So you should know what fair value is by now. And I'm sure you also know what we call cost to sell or cost of disposal, okay? So now, unlike other assets, that's what I'm emphasizing, so that when we solve questions, we will not struggle. Unlike PP, unlike what's it called now, intangible assets, okay, unlike IS 40, where on initial recognition, you have to use cost model. No way under IS 41, okay? Biological assets are measured at fair value, less cost to sell. Okay, now listen. Gain or loss may arise, okay? This must be recorded in the profit or loss account. So when you initially measure a biological asset at fair value, less cost to sell, okay? Gain and losses may arise, okay? You have to recognize it in the P or L account, okay? For example, a loss can arise because of the estimated cost might have reduced the fair value. Okay, so when you look at the fair value, okay, then you now say cost to sell, less cost to sell. So obviously it would have reduced your cost, okay, which is also the fair value. So obviously you are going to have a loss, okay. Now, and you recognize it immediately in the profit or loss account. Now, A gain can also arise when when a new biological asset is born. Okay, for example, you buy a calf or a cow, now give birth. Okay, so that's also a gain. It might be a gain. Okay, so you have to estimate it at fair value and you recognize it immediately in the profit or loss account. But I can tell you that in most cases you will always have a loss. Okay, you always have a loss. Okay, so we're going to see now on initial subsequent measurement. Now listen, on subsequent measurement. Okay, that means when you have done it the first time, so the second time now, okay, at the reporting date, okay, biological assets are revalued to their fair value, less cost to sell. Now, can you see it's simple? Both my initial recognition and subsequent recognition of measurement are the same. That's it. You don't struggle, right? It's quite simple. Okay, so at the reporting date, biological assets are revalued to their fair value, less cost to sell. Okay, so at the same time, gain and losses can also arise from changes in the fair value. So what do? You also recognize it in the profit or loss account. That's it. So both initial recognition and subsequent recognition of measurement, they are the same. Okay, so you measure at fair value less cost to sell. Okay, don't say I'm value in use. Okay, so there's no value in use there. So you measure it at fair value less cost to sell. Okay, all right. So gain and losses are recognized where in the P&L account. Okay, all right. So now look at this. Biological assets are presented separately on the face of the statement of financial position within non-current assets. So within your non-current assets, just like IFRS 5, you remember, assets held for sale. We also represent it separately. Now, the same thing is applicable here. So if I pick up a farmer's account or agricultural whatever's account, I should be able to see at a glance biological assets. Okay, so that means what it means is you don't add it as part of PPE. That's the meaning. Okay, normally when you say PPE, you have property, you have plants, you have equipment. Sometimes you have furnitures and fittings. Okay. Sometimes maybe the computer equipment, they are not really material. You lump everything up into your PPE, so you just say property, plant, and equipment on the financial statement. But here you have to show it separately by saying biological asset. Don't forget, biological assets are living plants or animals. Okay, now let's now look at this. The standard is saying something, inability to measure fair value. Okay, maybe it's quite difficult to measure the fair value. Okay, IS 41 presumes that the fair value of biological assets should be capable of being reliably measured. Okay, yeah, obviously, because when you say agriculture, of course, it's easily seen in market. Okay, that's why it should be easy to be measured. Okay, but if market price are not, readily available, then biological assets should be measured at cost, less accumulated depreciation and accumulated impairment losses. Okay, once the asset fair value can be measured reliably, it should be remeasured to fair value less cost to sell. So the standard is just trying to play safe here. Maybe in practice, it is quite impracticable to measure biological assets at the fair value less cost to sell. Okay, so the standard is now saying if there is no market that is readily available, then it should be measured at cost less accumulated depreciation and accumulated impairment loss. But once the fair value can be reliably measured, then it should be measured to the fair value less cost to sell almost immediately. Okay, now let's now demonstrate our understanding with this question. Okay, like I said, it's quite simple. It's very simple. After this one now, I'll take you through agricultural produce, then some how IS 16 and IS 2 is coming on board, and that's all. That's all. That's all. So you say a question in your exam, you just attack it. Okay, now let's look at this question. On 1st January 20x1, a farmer had a herd of 100 cows all of which were 2 years old. Okay? At this date, the fair value less point of sale cost of the herd was 10,000 naira. On 1st July 2021, the farmer purchased 20 cows, each 2.5 years old, for 60 naira each. Okay. At 31st December 2021, 3-year-old cows sell at market for 90 naira each. Market auctioneers have charged a sales levy of 2% for many years. Required. Discuss the accounting treatment of the above transaction in the financial statement for the year ended 31st December 2021. Okay, now this is brilliant. Now look at the requirements, just like some exercises we've been doing before now. Okay, now we were told to discuss the accounting treatment. So let me assume I'm in an exam hall, right? How will I know the standards they are testing? Okay, so right from here, they said a farmer had a head of cows. So obviously, it's IAS 41. Okay, so first thing that came to your mind, or that will come to your mind, since it's IAS 41, is what is the initial recognition? Okay, what is the initial recognition? And according to IAS 41, okay, a biological asset. So how do I know it's a biological asset, right? Because it's a cow. Okay, they didn't tell us whether the cow, they milk from the cow. Okay, so obviously it's a biological asset, because a biological asset is a living plant. Okay, the living plant or animal. All right, so I know. So all I need to do is, what is my fair value? What is my, I will initially measure at fair value less cost to sell. Okay, so that's what I will do. But they already told us that at 1st January 2021, the farmer had a head of cow for 100 cows, all of which were 2 years old. So I don't have issue with this. They now said at this date, the fair value less points, the fair value less point of sales is 10,000. So the examiner has already calculated the fair value less cost to sell is net. So I don't struggle with this. So this is the fair value at the beginning of the year. So I don't have a problem. Don't forget, that means it's already recognized in the financial statement. Okay, so all I'm looking for is initial recognition for the new cows that were bought. That's all I need to do. And at the year end, on my subsequent measurement, I have to also revalue to fair value less cost to sell. That's all I want to do. Okay, so I don't have a problem with that. So I move to the next paragraph. On 1st July 2021, the farmer purchased 20 cows. Okay, for how much? 60 naira. Okay, so I go into my book. All right, so if I'm looking at the solution, don't look at the solution, please. Okay, let's try and do it together. So I go into my book, as I've been doing. So if you have a sheet there, you can write, or you can do the calculation together. But if you want to listen, that's fine. Okay, now, so I go to my book. I will now say, how much did we buy? How many cows did we buy? 20. Okay, so I will say 20. I will say cost. That's 20 in bracket. 20 multiplied by 60. Okay, so if I press my calculator, okay, even if I cannot press, I can simply say 6 times 2, that's 12. There's 20. Okay, so that's 1,200. Okay, that's 1,200. That's my fair value. Okay, all right, that's the fair value. Okay, now I will now calculate cost to sell. So how will I calculate cost to sell? So I will ask the question, where is my cost of disposal or cost to sell? Okay, so the examiner says something here, that market auctioneers have charged a sales levy of 2%. Okay, so that is my cost to sell. So sometimes the examiner may not give you the absolute figure. Here now they are giving us in a relative terms. Okay, that's the 2%. So I can do it depending on your mathematics, how you know mathematics. So I can simply say 98%, okay, multiplied by the 1/2. Do you get the point? I can say 98% multiplied by the 1/2, or I can also say 2% multiplied by the 1/2 to give me the direct answer. That's it. So if I say 2% multiplied by the 1/2, I will get 24. Okay, I will get 24. But if I say 98% multiplied by the 1,2. I will get 1,176. So I will now remove 1,176 from the 1,2. I will also get 24. Okay, so that's a loss. So that's a loss. We said earlier, I told you earlier that most times when you measure at fair value less cost to sell, you always have a loss. So that loss of 24 will be recognized immediately in the P&L account. Okay, so that is the position on initial recognition. Okay, so that's the position on initial recognition. That's what we have just done. Okay, you simply look at 20 cows, okay, multiply by 60. It will give you 1,2. So I need to calculate my cost to sell. And we're told that they charge 2%. So 2% of 1,2, it will give me 24. That's my cost to sell. Or I simply say 20 multiplied by 60 multiplied by 98%. It's still the same thing. Okay, that's why I said it depends on your skills when it comes to mathematics. Okay, but don't forget, we are not done. The examiner said, what will be the accounting treatment at the end of the year? Okay, at the end of the year. Somebody might be thinking, we have not done anything here. I explained earlier that we have already been given the fair value less cost, so we don't bother. Okay, so this is more or less like the opening balance that we're just giving. Our concern was the new purchase during the year, and we need to initially measure it at fair value less cost to sell. So we now go to the end of the year. What will now happen? Okay, what will now happen? So all I need to do, don't forget, on subsequent measurement, all biological assets, we have to be revalued to their fair value, less cost to sell, and value in use. Okay, so all of them. So I will now go right from January 1. So I will now say my value at January 1st. How much is it? 10,000 naira. So I will write it under my naira sign in my note. Okay, at the extreme right. Okay, I will say value at January 1st, 10,000 naira. Okay, now I bought new cows during the year. Okay, I bought new cows during the year. Don't forget, it has already been measured at fair value less cost to sell. How much is it? 1,176, 1,176. Okay, so that was my new purchase during the year. Can you remember? That's what we just did. Okay, I will add it to it. Okay, I will now come to the end because I needed to revalue all of them at the end of the year. Okay, so I will now come. What is the value at the end of the year? So the examiner told me here that as at December 31, 2021, 3-year-old sold for 90 naira. Okay, when I bought, I bought 2.5 years, it was 6 naira then. But now 3-year-old now sold for 90 naira. Even the 2.5-old that I bought then, they would have grown into 3-year-old. Okay, so what will I need to do here? Okay, so I will now say value at year end. Okay, so my value at year end. So how do I get that? How do I get my value at year end? Okay, so how do I get my value at year end? So if you do what's it called, 90,000 naira each, okay, multiply by 120 cows. Okay, don't forget, we have 100 cows here, okay, and we have 20 cows that were newly purchased. So I need to revalue all my cows. What would be to their fair value at the end of the year? Okay, so that's what you are doing. So I'll now say 90 naira, just write in your note, multiply by 120. Okay, then I go into my calculator. Okay, so what will be the value? So I will say 90 multiplied by 120. So it's going to give me 10,800. Okay, that is the value at the end of the year. Don't forget, I'm revaluing to the fair value less cost to sell. Okay, so I will also apply this 2% again. Okay, I will also apply the 2% again. So if I look at the 2% of 10,800, okay, or I simply say 90 naira multiplied by 120 multiplied by 98%. It's still the same. It depends on, like I said, it depends on your skills when it comes to what's it called now? When it comes to mathematics. Okay, so I can now say, so let me check that. 10,800 multiplied by 0.2. Okay, so if you do that, it's going to give you 21. 60, okay, 2160. But I can do my 98% straight off, okay. So my value at the end of the year was supposed to be 10,584, okay. So if I have the value at the beginning of the year plus my new purchase, okay, so I will now compare. So I will say 10,000 plus 1176, okay, plus 1176 minus 10,584. So it will give me 592. So that's a loss, okay? So that's a loss. So that means I have a loss at the end of the year. You know, I said earlier that most times by the time you revalue to the fair value, you will always have a loss, okay? So you can look at the calculation. Okay, can you see now? So this was the 24 that we got the other time on the initial purchase, okay? That was what I was explaining the other time. Then at the end of the year, okay, can you see? All right, so if you do 120 times 90, okay, can you see now? So you can do your 98%. So you have this value at the end of the year. So that's what we have here, okay? That's the value that we have there. Now, how will I know whether I will recognize the loss or gain in my account? So I will simply look at the value at the beginning of the year, which is already given. That's the 10,000. And what was my new purchase? 1,176. Okay, so how do we get that? Can you remember? You simply say 98% of 1,2, okay? Or you say 2% of 1,2 and you remove it, okay? So that's how we got this figure here. Can you see it now? Okay, so if I add it together, it is actually higher than this figure, okay? So if you add these two figures together, okay, it's higher than this. So the difference between the two is giving you a loss of 592, okay? So that's what the examiner is asking you to do. It's as simple as that. All you need to do is on initial recognition, measure at fair value, less cost to sell. That's what we have done here, okay? And on subsequent recognition or measurement, okay, you have to remeasure again. You have to remeasure again at the end of the year to give you the value. So you now compare it to the figure that you are bringing right from the beginning of the year, okay? Right from the beginning of the year, okay? Now let's continue. Let's continue. Now we have dealt with biological asset. Like I said, it's very simple. Now, agricultural produce, okay? Agricultural produce. You know, we have said agricultural produce is the harvested product, right? Right from the biological asset. Now, listen, let's look at this. At the date of the harvest, agricultural produce should be recognized and measured at fair value, less cost to sell. Now, you have to be with me here. Be with me. In case you have not been listening, please put me on loudspeaker and listen to me. It's very simple, but I needed to show you how IS2 is coming on board, okay? Then later on, I will show you how IS38 and IS16 are also coming on board. They are having interface with IS41. So be with me. Now, when you want to go and harvest, for example, you want to harvest your maize in the farm, you want to harvest your cassava in the field, at the date of the harvest, agricultural produce should be recognized and are measured at fair value, less cost to sell, okay? So on a particular date that I go to my farm to harvest, I need to measure it and recognize it at fair value, less cost to sell, okay? Gain and losses on initial recognition are also included in the P&L account. Don't forget the same thing is also applicable to a biological asset. But listen, bear with me. There is a little difference here, okay? Now, let me say that again. At the point of harvest, I'm in my farm and I want to harvest my maize. I will measure it at fair value, less cost to sell, okay? Now, after produce has been harvested, okay, listen, after I have harvested my maize, okay, IAS 41 will cease to apply. Those maize that I have harvested, they become an item of inventory. So from that time onward, I will apply IAS 2. Okay, so that's it. Now, let me take it again. When I get to the farm and I want to harvest my maize, my mango, my orange, because they are ripe, okay? Before I pluck them, before I harvest them, I need to measure at fair value less estimated cost to sell. Okay, I need to measure at fair value less estimated cost to sell. Okay, any gain or loss right there are included in the profit or loss account. Okay, now after I have now harvested, I have plucked my maize, I have plucked my mango or oranges. Okay, they become an item of inventory immediately. IS 41 we cease to apply. Okay, so the initial measurement value at the point of harvest will now become a deemed cost for the purpose of IS2 inventories. What's the meaning of deemed cost, right? Okay, that's a surrogate cost. Okay, so when I measure at fair value less cost to sell, I will simply transfer that cost as inventory. That's it. That fair value less cost to sell as inventory. That's what they are saying. Okay, so you need to understand this area properly, and I kind of tested this area. Yeah, I guess maybe 2 or 3 nights ago. Yeah, they just explain how explain how agricultural produce should be treated in line with IS 40. Okay, and you needed to tell ICANN all this. If you are able to do this, then you have your 5 marks. Can you see? It's so cheap. It's as cheap as that. All you need to tell the examiner is that at the point of harvest, agricultural produce should be recognized and measured at fair value less cost to sell. Gain and losses on initial recognition are included in the profit or loss account. Okay, after produce has been harvested, then agricultural produce becomes an item of inventory. Therefore, IAS 41 will not apply again. So the initial measurement value at the point of harvest is now the deemed cost for the purpose of IAS 2 inventory. It's as simple as that. Okay. Now, this is the last point. Okay. After this, we treat one question, then that's bye-bye to IAS 41. It's as simple as ABC. Now, let's look at this. Asset outside the scope of IS 41. Okay, asset outside the scope of IS. Like I said, we have seen how IS2 is interfacing with IS 41. Okay, so we're going to see 3 more standards. Let's see how they are also interfacing with IS 41, IS 38, IS 16, and which other one? Okay, there are 3. Okay, IS2, IS 38, and IS 16. Okay, so we have seen IS2. All right. Now, IS 41 does not apply or do not apply to intangible assets. Okay, I'm going to take it intangible assets, for example, production quotas, bearer plants, or land related to agricultural activity. What do you mean by production quotas? When we get to IS 38, I will explain further. But when you say production quota, for example, you go to IIT in Ibadan, okay, you have an international tropical, whatever, okay, they are into agriculture, right? So they can give you production quotas that have information on crops that you can sow or whatever. Like I can say, I'm not really a farmer, so I'm just trying. Okay, now, so it will have a lot of information. Okay, if you want to do this, you do it on this type of sand, loamy or clay soil or whatever. Okay, so such as production quota, they can tell you how you can, those information can have the production process. Okay, so that's what we mean by that, and that is might be an intangible asset. Sometimes it's not really an intangible asset. So I'm going to tell you when we get there. Now, there's something we also call bearer plants. Okay, what do you mean by bearer? Now, you need to listen carefully. Okay, what do you mean by bearer plant? I am not a farmer. I have put up that disclaimer when I started. But let me try, okay? When you say bearer plant, for example, look at palm tree, okay? Palm tree might be an example of a bearer plant, okay? Because they can bear fruit for more than 1 year. They can bear fruit for 10 years, okay? They are just there, okay? Or let's say vine and vineyard, okay? We are going to get there anyway, okay? So that's what we call bearer plant. They use bearer plant to grow agricultural produce, okay? Now, the land that you are now using to grow your product, agricultural product, that's what I mean by land related to agricultural activity. So, IS 41 does not apply to them. IS 38 we apply to production quotas. IS 16 we apply apply to bearer plants, okay, as the case may be, okay, then land related to agricultural activity, IS16 will also apply. Okay, so that's what we want to look at for now. Okay, now listen. In accordance with IS38, intangible assets are measured at cost, less accumulated amortization or fair value, less amortization. Okay, so that's IS38. So IS41 does not apply to intangible assets. So, for example, production quotas, right? Okay, now bearer plants are used. Okay, can you see now? Are used to produce agricultural produce for more than one period. That's what I just said. Okay, now example includes grapevines. Can you see tea bushes? Grapevines, tea bushes. Okay, now bearer plants are accounted for in accordance with IS16. That's it. So in the next question, we're going to see how all these standards are interfacing each other. So you need to understand properly, right? Okay. So now a bearer plant is used to grow agricultural produce. Okay, and an example could be grapevines. Okay, so grapes grows on grapevines, right? Tea bushes. What grows on tea bushes? Maybe tea. I don't know. Okay, but they use it to grow agricultural produce, maybe cassava, maybe palm tree growing, palm kernel is growing. That's what I mean by that. Now, so you apply IS16 on bearer plant. However, any unharvested produce growing on bearer plants, such as grapes on grapevine, can you see now? It's a biological asset, okay? And it should be accounted for in line with IS41. That's what you need to understand. This is the most technical area in IS41, but it's quite simple, okay? Now, unharvested produce, like we said, you use bearer plant to grow agricultural produce. So all those agricultural produce growing on a bearer plant, you apply IS41. Now, once you harvest those agricultural produce from the bearer plant, IS41 will cease to apply. Then you now start to apply IS2. That's it. That's what we said earlier. Okay. Now, land is not a biological asset. You apply IS16. That's it. Because you are using land to grow agricultural to do what's it called, agricultural activity. Okay. So when you do your ridges and all the likes, the land itself, you apply IS16, provided you have control, right? Okay. Otherwise, to be a leasehold landed property as the case may be. Okay. Now, when valuing a forest, for example, the trees must be accounted for separately from the land that they grow on. Okay. So when you are doing your forest, you have to, when you are valuing forest, okay, you have to value it separately, and you account for it separately from the land that they grow on. Okay, so that's that. So if you are cool with this segment, and this is highly examinable, okay, the exam in both ACC and ICANN, the questions they have ever asked is it all the questions on IS41 is it. So you need to understand this segment properly, because that's what you are going to use to solve questions, right? So this IS41 can be tested in two ways, okay? In two ways, because it's corporate reporting. Maybe in financial reporting, it could be three ways. They can be asking financial reporting to say what's the biological asset, what are the recognition criteria, measurement criteria, and likes. But I don't think the examiner will ask you that. Okay, but you need to know it, because if you don't know that, you can't really solve questions. Okay, so the two ways they can ask you is to ask you to explain what I've highlighted on your screen, or they test your understanding of what I have highlighted in the question that we want to solve now. Okay, so just like this question. Okay, just like this question. So let's try and apply our knowledge on what we have just said on this question. Okay, Goodwine is a company that grows and harvests grapes. Grapevines, which produce a new harvest of grape each year, are typically replaced every 3 years. What does that tell you? Yeah? It looks like a bearer plant. That's it. Because they said Woodvine is a company that grows and harvests grapes. Grapevines, can you see now? which produce new harvest of grapes each year are typically replaced every 30 years. That means they can produce grapes for 30 years. Obviously, it's a bearer plant. Now, once you see that question, IS 41 is calling you. And what we have just said about bearer plant is you don't apply IS 41. What do you apply? You apply IS 16. Okay, then we move on. Harvested grapes are sold to wine producers. With regards to property, plant, and equipment, who are good wine account for land using revaluation model and other classes of assets using cost model. Can you see that now? Okay. So the examiner has told us that with regards to PPE, good wine, they will account for land using revaluation, okay, and other assets using cost model. Okay, now you can see now at your level, at corporate reporting class, okay, most likely you will not see a direct question on IS 16. Okay, I've not even seen it even in the last die. I'm not really too sure I've seen it. Okay, but it might be useful when you're doing your group accounting. But look at where it's coming up now. So that's why knowledge of almost all the standards is very key. So let's continue. On 30th June 20x1, its grapevines had a carrying amount of 300 and the remaining useful life of 20 years. Grapevines, okay, has a carrying amount of how much? 300 and a remaining useful life of 20 years. The grapes on the vines, which are generally harvested August every year, had a fair value of 500. Okay. Now, the land used for growing the grapes had a fair value of 2 million. Now, what is the information we need to get here? Grapevine had a carrying amount on June, okay, in June, right? Had a carrying amount of 300 and a useful life of what? 20 years. So, how will I account for my grapevine? The examiner already told me what to do, okay? They have already told me in my opening paragraph, okay? So they have a useful life of 20 years and this, that. So that means because they use other assets or class of assets, they use cost model. Can you see now? Okay, they use cost model. It is only the land that they use what? Revaluation model. So that's what you need to know, okay? And here, the grapes on the vines, those are the agricultural produce, which are actually are harvested in August every year at a fair value of 500. What does that tell you? At the point of harvest, okay, you estimate the fair value. The examiner had already estimated it. That's 500. So after I have harvested, what happened? It ceased to be IS 41. I will now apply IS 2. So that 500 will now be the deemed cost for the purpose of IS 2. That's that line. And this question, you are just explaining to the examiner. Can you see now? You are just explaining. Okay, now the land used for growing the grapevine had a fair value of 2 million. The examiner already told me that they use revaluation model for land. And here they are saying it has a fair value of 2 million. Can you see now? It's very simple. That's how you break down question. Okay. So don't think this place they are just making introduction. It has a linkage with the main body. Okay. On 30th June 20x2, grapes with a fair value of 100 were harvested. Can you see now? Okay, so grapes, okay, out of this 500 now, so the one that worth 500 was harvested early due to unusual weather condition. You know, they said they are supposed to be harvesting them in August, but they have to harvest them in June, okay? So they couldn't do so due to unusual weather condition. The grapes left on the grapevine had a fair value of 520. Now the land had a fair value of 2 million. So what happened? You revalue the land from 2 million to where? To 2.1 million. So what happened to the 1 million? Because I'm using revaluation model, I will record it in my other comprehensive income. Okay, because this is what's it called? This is PPE and not investment property. Don't worry. When we go to those areas, I will recap. I will once we do other standard, I will come back to those areas. Okay. So what happened to this one? The 1.1 million will be recorded immediately. Okay. Now all selling costs are negligible and should be ignored. What does that mean? Cost to sell are negligible. Now, the examiner now says, okay, I've analyzed the question. So that's how you do it. The examiner now says, discuss the accounting treatment of the above transaction in the financial statement in the books of good wine as at June 20 x2. Okay, so that's just how you break down the question. Now look at it. Land is accounted for in accordance with our system. That's it. Like I said, you just have to explain. If revaluation model is chosen, then the gains and fair value. Can you see? I recorded in OCI. That's it. Okay. Now, as at 30th June, the land. So all you need to do is pick the land, pick the bearer plant, and pick what's it called now? Agricultural produce, and apply applicable standards. That's it. IS2, IS16, and IS41. That's it. That was the line I was telling you the other time. So when you now pick land, for example, okay, it was revalued to 2 million, okay, 2.1 million. 100,000 should be recorded in OCI. No battle. You are done. That's it. Now you move to the grapevines, okay? Grapevines are used to produce agricultural produce. Can you see now? Over many periods. Can you see? This means that they are bearer plant. That's what I've been explaining. So therefore, you account for it using IS16, except for land. Goodvine uses cost model for PPEs. Can you see now? Because they use cost model for PPE. It's only land that they use evaluation. So therefore, you need to calculate your depreciation. Don't forget, they already told us that it has a kind amount of 300. So you divide by 12 to get your what's it called depreciation. Okay, to now be charged to P&L account. Okay, all right. So and the grapevine itself, okay, is having a kind. It will now be having a kind amount of 285. You know, when you remove the depreciation from the carrying amount. Okay, because that carrying amount means they have done depreciation as at that date. Okay, so you now need to calculate carrying amount as at if you look at the question, June 20x2. So just for 1 year, okay? Because the information started from 20x1. So what's the last one? What's the last one? Anybody? What's the last one? Okay, so let's go. Now, the grapes growing on the vines are what? Biological assets. So it should be revalued at the end to fair value less cost to sell. Any gain is reported in profit or loss account. So your biological asset will now be revalued to 520. Don't forget, there's a gain of 20 to be recorded in profit or loss. Now, the question already told us that we should ignore sales cost to sell. So the grapes are the agricultural produce. So and should be initially measured at fair value less cost to sell. Okay. So when you want to harvest, you have to initially measure it, okay, at fair value less cost to sell. Then you report it in P&L. So the harvested grapes you initially measure at 100 because they said out of that 500, 100,000, it was only 100. So you record it straight. So this 100 will now be accounted for in line with IS2, okay, and will be called the deemed cost. So once you harvest it, IS41 will cease to apply. Then you now begin to carry it at we now call it IS2, okay. All right, so that is IS41. Okay, now let's look at this. Okay, agriculture and government grant. Okay, maybe sometimes we are going to do IS20, accounting for government grants and disclosure of government assistance. So it's possible that if a government grant related biological assets, okay, measured at fair value less cost, then it's accounted for under IS41 as follows. Now, if a government is giving unconditional government grant related to biological assets, measured at fair value less cost shall be recognized in the profit or loss account when it becomes receivable. But once they give a conditional grant related to biological assets, measured at fair value less cost shall be recognized as profit when the conditions attached to the grant are met. Okay, so that's just it. It's very simple. Now look at this current pandemic. Now let's assume government is giving farmers some palliatives. Okay, if it is unconditional, once it becomes receivable, they can go ahead and recognize it. But once it's conditional, okay, because most times government grants are conditional. Maybe when we do IS20, we're going to look at that, but I want to treat other standards. I'll come back to IS20. I don't want to bore you. IS20 is meant for financial reporting class, okay? But if you have the time, I will also treat it. Very simple. I will also treat it. So once it's conditional, you can only recognize it when you meet the grant. For example, they can tell you that you should locate your farm in rural area. Okay, it's a condition. You have to fulfill the condition before you start to recognize the government grant that is related to agriculture. Okay, so that brings us to the end of IS41. Okay, as simple as that. Don't forget, we said IS 41 applies to biological assets and agricultural produce. And a biological asset is a living plant or animal. And before you can recognize a biological asset, three conditions must be met. Number one, it must be probable that future economic benefit related to the asset will flow to the entity. And number two, the cost or the fair value can be measured reliably. And the last one, the entity controls the asset. So once that one is done, then you are good to go to recognize your biological asset. And we said on initial recognition, gain and losses can arise. Okay, so whenever you have gain and losses, when you measure it at fair value less cost to sell, you recognize it immediately in the profit or loss account. So we also looked at what's it called, agricultural produce. We said at the point of harvest, you must measure your agricultural produce at its fair value less cost to sell, and you report it immediately in your operating profit. That's your profit or loss account. Okay. Once agricultural produce has been harvested, IS 41 will cease to apply. So from that time, IS 2 will apply. And the measurement, the initial measurement of the agricultural produce will now be the deemed cost for the purpose of IS 2. And we went ahead to also say that production quotas, such as related to agricultural produce, are not, IS 41 will not apply. Okay, so you account for production quotas under IS 38, intangible assets. And we also said that bearer plants, okay, like tea bushes, grapevines, and the likes, okay, that they used to grow agricultural produce, you use IS 16. Even the land that is related to agricultural activity, you also apply IS 16. Okay, so that is it. Now, this question that you have in front of you, you can use it as a practice question. It's quite very similar to what we have just done. This is a live ICANN question. The example we did in class, they are ACCA, is ACCA live question. Okay, so the question you have before you here is ICANN question. So you can go through it. If you have question, you can put it up. Maybe when you are practicing. Okay, so that will be fine. All right. So that's the end of IS 41. It's because I'm teaching, and some of you are listening, you are even hearing IS 41 for the first time. Like, which one is this one again? Okay, so that's why I took my time to explain, and I've already told you what the examiner will test. So you are not caught unawares. You know, when you are preparing professional exams, it's about strategy. You don't just read anyhow. You know what to read. Okay. Now, the next time you are going to pick IS 41 to read, just go to the agricultural produce, you know, where it's changing from IS 41 to IS 2. Then go to those standards outside the scope of IS 41. If you can grab that, you can apply it on any question. Okay. All right. So in case you have question, drop it on the chat. If you don't want to drop it, that's not a problem. You can chat me up, you can call. I'm going to answer you. And our next standard is IS 23, and we need to finish IS 23 today, so that by next week by God's grace, we will start with IS 21. Okay, effect of foreign exchange changes in foreign exchange rate. Then from there, I'll teach you substance over form. Okay, after that, you're going to do probably IFRS 2, IFRS 16, and people have been begging that you also take IFRS 9, financial instruments. So we're going to do that. So let's see as much as possible all the standards that we can quickly take, so that by third week, you will start your group accounting and cash flow statement. Okay, so that's why we needed to cover as many standards as possible, because by the time you start your group accounting, it will really help you. So knowledge of these standards will really help you. Okay, so next week too, I'm also thinking, I'm praying that time will not be against us, so that we can also look at IAS 19, employee benefit. Those are the uncommon standards that the examiner is using as a shocker. Okay, so we need to be aware. All right, I will try my best to break it down for you. Okay, so let's look at IAS 23 very briefly. In 30 minutes, I should be able to take this. Okay, but because sometimes I talk too much, because I like to explain, it may explain 30 minutes, but I'll be looking at the time. Okay, so are we ready? Okay, some of you are eating now. You didn't come, so let me take this water. All right. Now, borrowing costs. Now, listen. You have to listen. Okay. You have to listen. Even if, as a chartered accountant, you need to understand the standard. It's quite simple, right? It's very simple. So what do you mean by borrowing cost? Okay? What do you mean by borrowing cost? Borrowing cost. If you borrow money, for example, you go to the bank to borrow 100,000. You know, bank will not give you the money for free, right? So you're going to pay more than the 100,000 that you have borrowed. For example, they can say you are borrowing at 5% per annum. Okay? So if you are borrowing at 5% per annum, so if you apply 5% on 100,000, that should give you 105, if I'm correct, right? So that means you are paying both the principal and the interest. Okay? Now, so when you borrow money, the extra amount that you pay on money borrowed is what we call borrowing cost. Okay, so that's what we call like finance charge, right? Finance charges. Okay, so that's what we call, but the standard calls it borrowing cost. Now listen, before IAS 23, just the example I give now, if I go to the bank to borrow money, okay, the extra charges that I'm paying on the borrowed money, I will take it to my profit or loss account. Okay, I will take it to my profit or loss account as finance cost. Let me say that again. If I borrow money, that's before IAS 23, borrowing cost, before the standard before the standard was issued. So if I go to the bank and I borrow money, okay, now the excess charges, or the charge, not really excess anyway, the charge associated with that borrowing of funds will be recognized in profit or loss account. Okay, that means I will expense. That's the meaning. Now, IAS 23 now came on board, and I said, now, instead of expensing borrowing costs, okay, borrowing costs should be capitalized. Okay, what do you mean of capitalization? Capitalization means instead of me expensing it in my profit or loss, I can add it to the cost of the asset and recognize it in my statement of financial position, okay, or my balance sheet. Okay, I like to call it balance sheet. I don't know, but that's under the old standard anyway. So you call it financial position and balance sheet. You are still the same. It's still the same. Now, so instead of me recognizing my borrowing cost in the what's it called, a profit or loss account as finance charges, okay, I can actually take it to my balance sheet, okay, and add it to the cost of the asset. That's capitalization. So borrowing costs are defined as interest, another cost that an entity incurs in connection with borrowing of funds. That's it. That's how the standard has defined borrowing costs. Now listen, not all borrowing costs can be capitalized. That's the essence of IAS 23. Okay? That means if I borrow money, not all the money or not all the cost, the finance charges now can be capitalized. Okay? That's the first thing you need to know. Okay? Now, before I can capitalize a borrowing cost, okay, that cost must be directly attributable to the acquisition, construction, or production of a qualifying asset. So the question is, what is a qualifying asset? Are you getting the point? So if you go and borrow money to buy, let's say, to buy furniture into your office, okay, don't say because they have taught me borrowing costs, okay, it should be added to the cost of the asset. So you need to find out whether the money you have borrowed is directly attributable to the acquisition, construction, or production of a qualifying asset. If it is not a qualifying asset, that borrowing cost is going straight into your profit or loss account. But once it's a qualifying asset, IAS 23 permits or allows the borrowing cost to be capitalized. Now listen, what is qualifying asset? They are those assets that takes substantial amount of time to get ready for intended use or sale. Okay? Qualifying assets are those assets that take substantial amount of time to get ready for intended use or sale. Now, what is substantial? IS 3 did not tell us. But by judgment, you know that something that is substantial might take 5 years. For example, you want to build supermarket, you want to build a terminal bridge in Lagos, you want to build a Kanji Dam. Okay, it's a lot of projects. Okay, so and you borrow money to build a stadium. It's a qualifying asset because ordinarily building a stadium will take substantial amount of time, even if they are working there 24/7. Okay, it's going to take substantial amount of time. So the money you now borrowed for building a qualifying asset, instead of you charging the finance charges into the income statement of profit or loss, as it were, you can actually capitalize as part of the cost of that asset. All right. So that's the essence of IAS 23. Now listen. Not all borrowing costs can be capitalized. So the objective of IAS 23 is to regulate the amount of borrowing costs that an entity can, capitalize. Okay. So I've just explained what is on this page, even without looking at it, right? Okay. So you can go ahead and read it. All right. So I've tried to summarize what can you see now? That's the definition of qualifying asset, right? So I've tried to summarize that. Okay. So don't bother yourself. The examiner cannot be asking you any of the following assets may be a qualifying asset depending on circumstance. Yeah, that's what you just said. Made to order inventory, investment property during their construction stage, intangible assets during their development. Once it takes substantial amount of time. Okay, brother example, toll bridge. Okay, can you see? Just like the terminal I mentioned, power plant. Yeah, can be done. Okay, sorry. Hydroelectric dam. All right, they take large, substantial amount of time to get ready. Now, these are not qualifying assets, just for your understanding. Now, look at it. Inventory that are manufactured or otherwise produced in large quantities on a repetitive basis. So when you do something repetitive, maybe you have a manufacturer in India or China that produces inventory for you repetitively, even though it takes substantial amount of time, they are not qualifying assets. This is repetitive, okay? Assets that are ready for their intended use of sale when acquired, okay? They are already ready, okay? Now, qualifying assets measured at fair value, such as biological assets accounted for under IS 1, okay? So they are not qualifying assets, okay? So qualifying assets, they are what? Usually self-constructed, non-current assets. So in practice, it has to be self-constructed, okay? Now, this is the principle. That's what we want to do now. Borrowing cost eligible for capitalization. Now, you have to listen, okay? In most textbooks will tell you commencement of capitalization, and they will tell you cessation of capitalization. So what they have done is they have married cessation of capitalization with suspension. Okay, suspension of capitalization is actually different from cessation. So I've tried to break it down in this note so that my students can understand better. So once you can consume what we want to do now, you are fine with borrowing costs. Because like I said, it's a principle we need to understand. So when you see questions, you just be, overcoming the question as simple as that. Now, what do you mean by commencement of capitalization? It simply means when do I start capitalize? Don't forget, you cannot capitalize all borrowing costs. Okay? Before you can even consider capitalization, it has to be related to construction, acquisition, or production of a qualifying asset. Okay? So once it's a qualifying asset and you have borrowed, when do you now commence capitalization of borrowing cost? Now listen, before you can commence capitalization of borrowing costs, 3 conditions must be met. Let me say that again. before you can commence capitalization of borrowing costs, three conditions must be met. Number one, expenditure for the asset is being incurred. Number two, borrowing costs are being incurred. Number three, all activities necessary to get the asset ready for intended use or sale have started. Okay, three conditions. You have to listen before I can commence capitalization of borrowing costs. Okay, three conditions must be met. Number one, expenditure for the asset is incurred. What does that mean? It's very key, and date is also key. What's the meaning of expenditure for the asset is being incurred? It's possible that I have gone to borrow money. I borrow money in January, okay, but construction started in February. Expenditure did not start in January that I borrowed, but expenditure started in February. What it means is the finance charge for January will be expensed. Listen to me and be with me, okay? Expenditure for the asset is being incurred, okay? So I borrowed money in January at 10% interest rate per annum, okay? But expenditure started. That means construction begins in February. So what it means is the finance charges for January will be expensed. So when will I commence capitalization of borrowing costs? I will have to commence in February because that's when expenditure has started. Now, but before I can even commence, I will check again. Borrowing costs are being incurred. What's the meaning of borrowing costs? So that means if I did not go to borrow, there is no borrowing cost. I must have borrowed before there is borrowing cost. Okay, so that's all you need to know. So let me give you an example or to give date. So if I borrow money in January, okay, and I start construction in February, our capitalization will start in February. Borrowing cost already started in January. So but the finance charge from January will be expensed. Now let me give you another example. I started construction in January. That means expenditure has started. I started construction January 1, 2020. Expenditure has commenced. But I borrowed money in February. When will I start borrowing costs? My class. When will I start borrowing costs? I started construction in January, but I borrowed money in February. When will I start borrowing costs? January. You're on your own. You will start borrowing costs in February because that is when you incurred borrowing costs. Can you see now? That's how the examiner disturbs students. You need to understand this. It's as simple as that. Then number three, all activities necessary to prepare the asset for intended use or sale are in progress or they have started. Okay. So, but I'm sure the examiner will always play around these very first two conditions. So, in case the examiner asks you to, explain the period of capitalization, that's how you start, and that's what you do for the examiner. So, you need to understand those 3 points properly. Okay. So, before you can recognize or before you can commence borrowing cost, okay, what happened? Number one, number one, expenditure for the assets is being incurred, borrowing costs have been incurred, and activities necessary to get the asset ready for intended use or sale have started. Now, like I said, I've broken it down into 3. Suspension of capitalization. Like I said, it's actually different from cessation. Now, when you say cessation, you stop finally. But suspension is just temporary. You stop, then you continue again. Okay, and that is where the calculation is. Now, capitalization of borrowing costs shall be suspended during an extended period in which active development is interrupted. Now, listen. For example, I started construction in January. So around May, there was labor strike or there was a short supply of material. Okay, so the interest, the finance charge or the interest on borrowing for May will not be capitalized. That's what it means. Now listen, if I start construction in January and I borrow money in that same January, okay, borrowing cost will start. Okay, so January, February, March, everything was going on. Okay, all of a sudden in April, there was lockdown. Okay, there was lockdown. We cannot work again. All right, or there was labor strike, or there was shortage of supply. Okay, we cannot work again. So for that period, for that April, it could be 2 months, it could be 3 months, okay? For that period, I will suspend capitalization of borrowing costs. What does that mean? I will expense it. That's the meaning. I will expense it. Okay, now listen to me. However, okay, however, if that period of suspension or interruption is necessary to get the asset ready for intended use or sales, borrowing costs will not be suspended. Can I say that again? If the interruption, the active interruption to development program is necessary to get the asset ready for its intended use or sale, borrowing costs will not be suspended. What does that mean? For example, I'm building a building. Huh? Is that correct? I'm building a building. At least you understand what I'm saying. Okay, fine. Okay, I'm constructing a building, right? Okay, now, and I now do what they call decking. Okay, I did a decking. You know, normally you wait for maybe 21 days thereabout for the concrete to solidify. Okay, in that case, that waiting period is necessary to get the asset ready for its intended use or sale. So in that case, you continue to capitalize borrowing costs. So those are the things the examiner will be doing, you know, when they ask questions or when they ask you questions on borrowing. Can you see now? Now, so that's what this place is talking about. So you have to put it in your head in case you are asked to explain. Now, but for cessation, okay, obviously cessation is the final stoppage. You are stopping final. Don't forget, I can borrow for 3 years. Okay, I can borrow money for 3 years. Meanwhile, the construction took me 2 years. Will I continue to, to capitalize borrowing? No, of course, I have to cease. So substantially, when all activities necessary to prepare the qualifying asset for intended use of sale are complete. Now I've completed the building, I've completed the Kanji Dam, the stadium, the supermarket. Okay, so I will stop borrowing costs. Okay, or when construction is suspended due to industrial dispute. For example, you took a loan to construct a bridge on behalf of the for government. All of a sudden, there was this industrial dispute or maybe political whatever, and it was abandoned. Okay, so in that case, you have to stop borrowing cost. Okay, all right. So look at this. The costs that are already been capitalized remain part of the asset cost, but no additional borrowing cost may be capitalized. Okay, even if you have to resume in later. Okay, you can't really do that. Okay, all right. So let's look at the very first illustration. You know, I like when we learn a principle, then let's demonstrate it in a question almost immediately. Okay, with demo. That's why you have seen my own system of teaching. We learn principle, we look at question. We learn another principle, we look at question. So it will now build your confidence into seeing a larger question that contains all the principles. Okay, so that's it. So let's learn. Let's try to see an illustration to demonstrate when to commence borrowing costs, when to suspend borrowing costs, and when to cease borrowing costs. Okay, on 1st January 20X1, on 1st January 20X1, ARAS obtained planning permission to build a new office building. Okay, on 1st January 20X1, they obtained a planning permission to build a new office building. So when I see that statement, something is not really too clear. I'm not sure whether they are testing IS41, IFRS 5, IS36, or IS23. So I read further. Okay. Now they said, because when they say they obtain planning permission, it may also be one of the criteria under IFRS 5. So I don't know yet. So I continue to read. Okay. Construction commenced on 1st January 20X1. Oh, they started construction. Obviously, it's not IS36. Obviously, it's not IS41. Obviously, it might not be IFRS 5. So I continue to read. To help fund the cost of the building, a loan of 5 million was taken out of the band. Oh, it's becoming clearer. This is looking like borrowing cost. Why? Because they want to construct a building. They want to construct a new building office. Construction has commenced on 1st January 1. Okay. So because they don't have enough funds, they went to the bank to borrow. Okay. So that looks like a borrowing cost. And the interest rate is 10%. I continue to read. Construction of the building ceased during the month of July due to unexpected shortage of labor and material. IAS 23 is calling me. This line is talking about suspension, okay, of borrowing costs. By December 21, by December 20X1, the building was not complete. Costs incurred to date were 12 million, excluding interest on loan. Required. Discuss the accounting treatment of the above in the financial statement of IRIS for the year ended 31 December 20X1. All these questions were carefully selected. You cannot be expecting the examiner to be telling you, in accordance with IS 23, discuss the accounting treatment. No, you must be able to identify, and I have incorporated it in my method of teaching so that you see how to identify all those standards when you are seeing questions. So what do I do? Okay, don't look at the question. Let's try and solve it together. Then we'll go and look at the question together. If we miss it together, we'll be beaten together. But we cannot miss it. Do you know why we cannot miss it? Because we understand the principle. Because we understood the principle. Once we understood the principle, all you need to do is to apply the principle. Even if you don't know how to start this question, why don't you explain the principle to the examiner first? Okay, now you tell the examiner that before borrowing costs can be capitalized, 3 conditions must be met. Expenditure for the asset must have been incurred. So I look at the question, expenditure for the asset. When did you start? Okay, now so I look at it. They said construction commenced 1st January. They have commenced. Okay, so that is it. They have made that condition. Then I need to ask again, if construction commenced in 1st January, on 1st January 20X1, when did we borrow money? Okay, because before I can capitalize, construction must have commenced, that's expenditure must have been incurred, borrowing costs must have been incurred, then all activities necessary to get the asset ready for intended use or sale I must have started or are in progress. Okay, so I now ask again, where did we borrow? They said to help help the fund of this loan building, a loan of 5 million was taken when 1st April 20X1. Those 2 conditions had been made. No, I told you, date is very important as well. We commenced construction 1st March 20X1 and borrowing costs, or we borrowed money 1st April 20X1. So those 2 conditions have been met. If I want to check again, what about the last condition? All activities necessary to get the asset ready are already in progress. They said on 1st January, IRIS obtain a building permission. That is it. All the 3 conditions has been met. You know, when I start like that, I already building confidence into the question. So the question is this: the 3 conditions have been met. So that means capitalization of borrowing costs can commence. So the question is, when do I commence capitalization of borrowing costs? So I look at the question again. Commenced 1st March 20X1. That means I was using my money, okay, to do the construction. So because the money was not enough, and I went to the bank to borrow on 1st April. It simply means that capitalization of borrowing costs will start 1st April. It's as simple as that. And I look at the requirement. The examiner is telling me that I should calculate the borrowing cost up to December 20X1. Then I count from April that I need to commence my borrowing cost. By the way, what is my borrowing cost? I borrowed 5 million at 10% per annum. So I will simply say 10% of 5 million. That is my borrowing cost. So in which month will I commence capitalization? I will commence in April because that's when I incurred borrowing costs. Okay, but I must have checked the expenditure for the asset had commenced earlier. Are you seeing the point? Let's assume that they said expenditure commenced in May. Borrowing cost will commence in May. That means in April. The borrowing cost in April will be expensed. Okay, that's what you need to understand. Then I move on. So when I had those information, I will now count from April because borrowing cost will commence from April to December. Like I said, don't assume. Use your fingers. April, May, June, July, August, September, October, November, December. 9 months borrowing cost. Okay, I need to capitalize for 9 months. But wait. I may not be able to capitalize for 9 months because there is suspension. There is also what's it called? Cessation. So I will ask the question again: is there any suspension? Because I know at the back of my mind that suspension will only occur when there is an interruption to active development. However, construction will continue, will not be ceased or will not be suspended if the waiting time or the interruption was necessary to get the asset ready, then I ask the question, is there any information on suspension? If there is information on suspension, I will ask again, is it necessary to get the asset ready for intended use or sale? Okay, so I'll now say construction of the building, okay, ceased during the month of July. Okay, so what happened? Why did it cease? They said due to unexpected shortage of labor and material. Okay, so this cessation or this what's it called interruption is not necessary to get the asset ready for intended use. So what will I do? I will not capitalize for the month of July. You know, we have already counted month of July the other time when we said April, May, June, July, August, September, October, November, December, 9 months. Okay, so what it means is I will not have to capitalize for 8 months. That's the meaning. I will have to capitalize for 8 months. Okay, so when I'm calculating my interest here, I will say 10%. Don't forget, 10% of 5 million will give me for the whole year. I will now say multiply by 8/12. That's it. That's it. That's the end of the question. As simple as that. Okay, and they told us that the cost to date was 12 million. That's the cost to date. So I've just add the interest to the 12 million. That's it. So let's look at what I've just explained. Okay, yeah. Can you see? Okay, can you see? Okay, so to make things easier for yourself, you do this. That's it. You do that for the examiner. That's what I've explained. Then you move on. So capitalization of borrowing cost will commence in April. Okay, then capitalization of borrowing cost ceased in the month of July because active borrowing was suspended. So in total, 8 months worth of borrowing cost will be capitalized. That's what we have done. Can you see? It's very simple. Can you see? 5 million, 10%, 8/12. So you have this figure. Okay, so you now add it to the 12 million as of December. That's it. It's as simple as that. Now you will not depreciate. Why? Because the building is not ready. It's still within work in progress. Okay, that's it. That's it. All right. So if you can understand that, then you are good to go. I have 2 things more to show you under IS 3, and we say bye-bye to IS 3. So let's see whether we can do that within the next 15 minutes thereabout, so that I can see whether you have questions. Okay. So we are going to look at specific borrowing and general borrowing. In fact, general borrowing is so simple. Even specific borrowing is so simple. It's just that you need to apply matching concepts. That's it. Okay. You need to apply matching concept. Okay. All right. So let's look at specific borrowing. Now, what does this mean? I went to borrow 5 million naira, for example. I borrowed 5 million naira. Okay. So now, that 5 million naira that I borrowed, I did not need all of them almost immediately for the construction of a qualifying asset. And I went to invest. Again, you know, I borrowed money and I went to invest part of that money. I reinvested it. Okay. So when I invest that money, I'm going to have what we call investment income. Okay. I invest maybe in Forex, or maybe I did what's it called? Fixed deposits, I bought treasury bills. Anyhow, okay, I invested and I now get what's it called now? Investment income. So what IS 23 is now saying is this: if you borrow money and you went ahead for qualifying assets now, right? Okay, and you go ahead to reinvest that money you have borrowed. Okay, so what it means is the borrowing cost that will be capitalized should be the amount of borrowing cost minus the investment income on that borrowing. That's it. If you can grab that, okay, that's it. So if normally when we did earlier now, we got 333 borrowing cost. Let's assume we reinvested part of that money. Okay, so the investment income that we got, we have to remove it from the borrowing cost that should have been capitalized. That's what we want to look at for. Okay, so that's what this is saying. Where borrowing costs are made specifically to acquire a qualifying asset, borrowing costs may be capitalized, those actually incur less any investment income on temporary investment. Lobaton, that's it. Okay, in case you don't understand Lobaton, I mean that it means that is it. Okay, all right. Now, so let's look at this example to test that principle. That's what I like that. Okay, we learn a principle, we test it. We learn a principle, we test it. So by the time you now say a complex or big question, it's just those principles they are testing. So you are fine. Okay. Now look at this very small question. The question seems small, but the calculation is big. But it's just very simple. Greentown took out a loan of 10% at 6% from on 1st January 20X1 to build a new football stadium. Now, IS23 is calling me, okay? Because football stadium is a qualifying asset. And I took out a loan to build, okay? Not all the funds was immediately required. So out of the 10 million, Greentown reinvested 2 million in 3% bonds until June 20X1. Don't forget, date is key in your exams. Can you see? We borrow money here, okay? That means it's for the whole year. This 6% is for the whole year. Now, I reinvested. Out of the 10 million, I invested 2 million, okay? At 3% bond. That means I will have investment income at 3%, but that bond was for 6 months. Meanwhile, the 3% is for the whole year, okay? Now, it's just mathematics, right? So that means I will say 3% multiplied by 2 multiplied by 6 over 12. That's it, okay? Because this is 30th June. If they have said 1st June, it will be 5 over 12, right? Okay. Now, construction of the stadium began 1st February. Now, look at the trick now. I borrowed money 1st January. Construction started 1st February and was completed in December. Now, calculate the amount of interest to be capitalized. In fact, this one is even straight for the Kwame. They already say to be capitalized, so you know already. Even if you are not sure whether you are testing IS23 here, right? Okay, because sometimes it might look like financial instruments sometimes, right? Okay, so in respect of football stadium at 31st December 20X1. Okay, now what do I need to do? Now, expenditure for the assets must have been incurred. So when did they incur expenditure? February. Can you see now? When did I borrow money? Borrowing cost has been incurred. I borrowed in January, but expenditure started in February. So when will I start capitalization of borrowing costs? My class, when? I cannot hear you, obviously, but I just wanted to say it. So let's see whether you get it. When will I start capitalization of borrowing costs? When I borrowed in January, expenditure commenced in February, so I will start in February. That's the meaning. I will start in February, okay? I'm going to start in February because that's when construction begins. So that means the borrowing cost for January will be expensed. So that's it. So I will now calculate, I will now say 6% multiplied by 10. So they did not give me information about suspension, or borrowing cost or cessation. So I assume it goes throughout the year. So if I calculate 6% of 5 million, of 10 million rather, how much would that one give me without pressing my calculator? I think I should be able to do that. That should be around 600,000 if I'm correct. Okay. In case I'm not correct, I'm very sorry, right? Because I'm not really using calculator because of time. Okay, but it should be around, is it 600 or 500? Okay. All right, so you get a figure. That means it's for the whole year. Okay. So you now multiply by 11 over 12 to get the actual amount to be capitalized. The 1 over 12 of the answer, that's 1 over 12 multiplied by 600 should give you, is it 50,000, will be expense. You get the point? It will be expense. So you treat that. You now come back to the investment income, okay? We're told that we invested 2 million. Don't forget now, we already have 550, Abi, because if you do, let me say that again, if you do 10% of 6% of 10 million, you have 600,000, okay? But because borrowing cost, or what's it called? Expenditure commenced in February. So January's interest, that's 50,000, will be expense. So I have 550 to be capitalized. Okay, but there is a principle that when you borrow money to construct an asset and you reinvest that money, so the investment income should be deducted from the original borrowing cost. So you now capitalize the balance. So I will now go back. Sorry, I will now go back to the my investment income. So I have sorry, is impairment. Sorry. Now I have 2 million of 3%, okay? So if you do 3% of 2 million, what will you get? Okay, you have the answer. But don't forget, you will now have to do 6 over 12, okay? Okay, so let me try to do that in my calculator so that as I'm explaining, I'm quoting the figures, okay? So if I do 2 million multiplied by 0.03, okay, I have 60,000, okay? But that's not what I'm going because it was invested until 30th June. So I will now say multiply by 6 divided by 12. Okay, so I have 30,000. Okay, so my investment income is 30,000. Now be with me. Be with me here because that's where you now apply matching concept. Okay, now when I have 30,000 for 6 months, so now the amount that I'm going to remove from my original borrowing cost of 550 must match, okay, must match with the period of the borrowing cost. You know, borrowing cost commence in February. So when I reinvested from January, it simply means that the January's investment income will be in the will be taken to profit or loss account. So the investment income I'm going to remove from my borrowing cost will also start from February. That's the matching concept. So I'll now say 1 over 6 multiplied by 30,000, or I say 5 over 6 multiplied by 30,000, as the case may be. I will have 25,000 or I will have 5,000. So 5,000 will go into my PON. I will take it as investment income. Meanwhile, the other balance of 25,000 from February to June, okay, it will now be taken out of my borrowing cost. And that's the end of the question. Okay, so let's look at that. Okay, can you see now? Okay, yeah, this is 600. I actually got it right. Okay, and okay, so this is 50,000. Can you see now that we go as finance cost in the income statement? Can you see? You see explanation? Okay, so the same thing. We also go to income here. Okay, can you see? Yeah, that's it. That's 30,000. Okay, and you do this. Okay, and the 1 month interest will be taken to profit or loss, and the 25,000 is relating to the asset. So what you now do? The 50,000, the 550,000. Normally, if we didn't reinvest, this 550,000 should have been capitalized, but because we reinvested, so we need to remove it from it. So 525 will now be capitalized. So this is just the accounting treatment. That's it. That's it. And that's all. Okay. That's all. So let's now look at the last one. That is general borrowing. Okay. You know, when you say specific borrowing, like we have said now, the one we just did, that means you specifically borrowed for it for an asset. But when you talk about general borrowing, you just have a lot of borrowing in your account. Okay, you have loan 1, loan 2. You know, sometimes you just borrow, right? Because you're anticipating you might need money anytime. Okay, you don't really borrow specifically to construct an asset. You just borrow. So you have loan 1, loan 2. You have overdraft and the likes. Okay, so all of a sudden you want to construct a qualifying asset. So you now realize that, oh, I have enough funds, okay, in my loan account. So I can use those money to actually construct a qualifying asset, okay? So because it's general borrowing, you did not specifically borrow to construct that asset. That's why they call it general borrowing. So in that case, I-23 now says you are going to do what we call, you are going to apply what we call capitalization rate. That means you needed to calculate the rate that you are going to use to determine the amount to be capitalized. That's what we call capitalization rate. And I've made it easy for you students. All you need to do is look at the interest charges or interest incurred for the year over total number of loans. Okay, this is the way the standard has put. In fact, the standard didn't even really write the formula. Okay, I have to create this formula. Okay, but because it's capitalization rate. Okay, so that's why average is there. But obviously, you are calculating total loan. Okay, that's to be the total loan. So, for example, I have loan 1, loan 2, loan 3. Okay, so I will calculate the interest on those loans. It will be my numerator, Abi. The one on top is the numerator, Abi. Okay, fine. So it will be the numerator. Okay, the addition of all the loans is the loan. So is the total loan or average loan for the year. Now multiply by 100%. So the rate you get is your capitalization rate or the amount you get. Okay, you now apply that rate on the cost of the asset to determine your borrowing cost. Okay, so let's see an illustration here. Okay, can you see? If a company had 10% loan, okay, if a company had 10% loan, can you see that from your screen? Okay, okay. If a company had 10% loan at 6%, okay, and 2% at 8%, so you now say interest charges for the year. So you say 10% of 6%, you add it plus 2% of 8%. You now say 10 million, this loan, plus this 2 million. That's what will be on your denominator. You multiply by 100, so you get this 6.33%. Okay, 6.33%. Okay, so this amount will now be capitalized. So let's look at an exercise to illustrate that. Okay, an entity has a number of general loan arrangements. Can you see that? Loan 1, 800,000 at 9%. Loan 2, 2 million. Loan 2, 2 million at interest of 8%. Okay. Loan 3, 400,000 at 7.5%. Now, the entity has commissioned a new printing press to be constructed on its behalf. Can you see now? So they have borrowing, general borrowing, okay? So the total cost will be 800,000 and the entity will be able to fund the purchase from the existing borrowing. Can you see? Since it has arranged for stage payment to be made, the construction takes 6 months. Required. Calculate the amount of interest to be capitalized. Okay, calculate the amount of interest to be capitalized. So what will you do? You just say capitalization rate equals interest charges on loan or interest charges for the year over total number of loan. So on my numerator, I will say 8% at 9%. I will get a figure. Okay, 800,000 at 9%. I will get a figure. I'll get a figure. 2 million at 8%. I'll get the figure. Okay. 400,000 at 7.5%. I'll also get a figure. I will add it together. Okay. I will now divide by 800,000 plus 2 million plus 400 multiplied by 100%. So I will get a rate. So the rate I get, I will now multiply it. I will calculate it on this 800,000. But take note, we were told that the construction takes 6 months, okay? It's not the whole year. So I'll now say the rate I got multiplied by 800,000 multiplied by 6/12. So the amount I get is my borrowing cost. I will now add it back to the cost of the asset, which is that 800,000. So let's look at the solution. Okay, can you see now? So this is it. So you do this, okay? That's what I just explained. You do this, okay? So by the time you do all of this summation, multiply by 100%, you have 800,000. So the borrowing cost to be capitalized will now be the cost of the asset multiplied by the 8% because it takes 6 months. That's why you have 6/12. So you have 32. So this 32 will now be part of the cost of this asset. Okay, it will now be part of the cost of this asset. If it takes 1 year, that means this one will be 12/12. That's 1. So you don't need to bother yourself. Just be 8% over 800. The figure you get, you now add it back to the cost of the asset. Okay, and that brings us to the end of IAS 23, borrowing cost. It's as simple as that. You only need to know 3 things, okay, or let me say 4 things. Know that borrowing cost applies to a qualifying asset, okay, and qualifying assets are those assets that take substantial amount of time to get ready for their intended use of sale, okay, and before you can capitalize borrowing cost, 3 conditions must be met. Number 1, expenditure for the asset is being incurred. Number 2, borrowing cost is being incurred. And number 3, all activities necessary to prepare the asset or to get the asset ready for intended use of sale are in progress or are started. Okay, then you suspend borrowing cost if development program has been interrupted. However, if the interruption is necessary to get the asset ready for intended use of sale, borrowing cost will not be suspended. Then you cease borrowing costs if substantially all activities necessary to get the asset ready for intended use of sale are complete or the construction program has been abandoned. Okay, so we looked at the illustration and from there we also looked at specific borrowing. So we said when you borrow money and you reinvest that money, the borrowing cost that you capitalize will be the original borrowing cost less any investment income. And you have to take care, you have to be sure of the date. So you have to apply matching concept. And the last aspect is the general borrowing. So in that case, you are going to do what we call capitalization rate, where you look at the interest charges for the year or on those loans over total loan multiplied by 100%. So any figure you get, you apply it on the cost of that asset, then you add it back to the cost of the asset. So that's the amount to be capitalized. So IAS 23 is very simple. So you can look at this question. There's some question here that will further solidify your understanding on IAS 23. They are very simple. So you can go through them. If you have questions, or I've seen some of you guys, you've been bombarding me with what's it called, solved examples in the past, and that's very good. So I'm going to use this weekend to go through them, so you will get back from me, okay? So I'm sorry for the delay. I've been very busy at work. Okay, so before we go, let me see if I have one or two questions there before we enter case study class. Okay, before we have a case study class. Okay, somebody is saying, why is the estimated cost deducted from fair value? That's the principle. Okay, I think that's under agriculture. It's the principle. Okay, fair value less cost to sell. So you get the fair value, you now remove the cost to sell. That's why we remove it. So that's the principle. Okay, okay. Must all the three conditions be met? Can it just be two or one? No, all the three conditions must be met. Okay, all the three conditions must be met. Please, can you re-explain the capitalization rate? Okay, okay, let me re-explain again. I think I've said that about two. Okay, now let me re-explain capitalization rate. It's a formula. Okay, just look at the interest on loans or overdraft or whatever. Calculate the interest, 2% of 1 million, 3% of 3 million, 1%, okay? So you calculate the interest, then the total loan, the original loan, you add it together. So the interest up, the total loan down, add it together, multiply by 100%. So that's how you get your capitalization rate, okay? Please explain the matching concept application in exercise 2 again. Okay, so let me explain. Now, we borrowed money in January. If I remember that question, we borrow money in January, immediately we reinvest, okay? Meanwhile, construction begins in February. So if I want to capitalize, I will start from February, okay? Now, the amount of investment income that I will remove from my borrowing cost will also start from February. That's the matching concept. I cannot start from January because expenditure did not start in January, okay? So that's the matching concept. If you are not still clear, you can let me know much later. Okay. No other questions. So I want to believe we are on the same page. So I'm appealing to you. If you have not been reading, maybe throughout the week, you are also busy at work, and So please use this weekend to go through what we have done. Okay. As of today, we are not sure when you can write when the exam is coming up, but I can assure you that it will come up in July. Okay, I did not hear any information, but most likely it's going to come up in July. Why? Because in the next 1 or 2 weeks, they are going to lift ban on school activity. Okay, everything will technically return to normal. Okay, so what they will just expect is good hygiene, training procedures. In fact, I'm even hearing flights will start. Okay, they will start flights, at least domestic flights, in the next couple of weeks. Okay, so if that will happen, so what will most likely happen is for ICANN to sit back and come up with strategies to write this exam. For example, they can say all foundation write in the first week, maybe in the first week, all skills write in the other week, so that they can do rearrangement, the sitting arrangement in the exam hall, okay? In the other week, professional will write. So most likely, it might be from mid-July into August, or it's just say batch A, batch B, batch C, okay, to still mix all the levels together. So you need to start preparing, okay? Start preparing. Don't say we still have June. No, ICANN exam is, the syllabus is wide, but we have tried our best to stage this kind of program and to also break it down to pieces so that you can understand. And for me, this is the most difficult lecture I've ever done, lecturing people you don't see. I don't even know whether you are laughing at me, whether you are laughing on top of me, whether you are laughing below me. I did not know. But notwithstanding, I love you guys. I'm going to see you next week by God's grace. Have a wonderful weekend. Let me just take some water before I enter case study class. All right. Take care of yourself. Good night. Thank you.